When Canadian Prime Minister Mark Carney recently appeared beside a map of the United States, the image immediately caught the attention of political analysts, business leaders, and millions of Americans online. At first glance, it looked like an ordinary political presentation. But many commentators quickly suggested that the map carried a much deeper message. Not a military strategy. Not an election strategy. An economic strategy. According to several analysts, Carney wasn't talking about attacking America. He was talking about understanding America. More specifically, understanding which parts of the United States depend the most on trade with Canada. If that interpretation is correct, it represents an important shift in how economic competition between close allies is evolving. Because in today's interconnected economy, governments don't necessarily need military force to create pressure. Sometimes, trade relationships alone are enough. And that's exactly why economists have started paying close attention to the growing trade tensions between Washington and Ottawa. Canada has long been America's largest trading partner. Every single day, billions of dollars worth of goods cross the border. Cars, oil, natural gas, electricity, steel, aluminum, agricultural products, wood, machinery, medical equipment. The list goes on. For decades, both countries built supply chains based on one simple assumption. The border would remain stable. Trade would remain predictable. Businesses could invest with confidence. That assumption is now facing its biggest challenge in years. As political disagreements increase over tariffs, industrial policy, manufacturing subsidies, and economic security, companies on both sides of the border are beginning to rethink long-term investment decisions. And this is where the map becomes important. Not every American state depends equally on Canadian trade. Some states conduct enormous amounts of business with Canada every year. Others have relatively limited exposure. If Canada were to redirect purchases, delay investments, or respond to future American trade restrictions, the economic consequences would likely be concentrated in specific regions rather than spread evenly across the country. This explains why some analysts have suggested that a relatively small number of Republican-led states could experience greater economic pressure than others. The discussion isn't really about politics. It's about geography. Take the automotive industry. A vehicle assembled in Michigan may contain parts manufactured in Ontario. Those parts may include steel produced in another American state. Electronic components could arrive from Mexico. Software may come from California. Battery materials could originate in several different countries before final assembly. Modern manufacturing no longer happens inside one country. It happens across entire continents. Interrupt one part of that network, and costs increase everywhere. The same principle applies to agriculture. American farmers export enormous quantities of grains, dairy products, meat, and food ingredients to Canadian markets. At the same time, Canadian fertilizer, farming equipment, and agricultural materials support American production. Neither economy operates in complete isolation. This is why economists often describe the United States and Canada as operating one of the world's most integrated economic partnerships. That partnership supports millions of jobs. Not only in large corporations, but also among trucking companies, small manufacturers, rail operators, warehouses, local suppliers, engineering firms, construction companies, technology businesses, and family-owned exporters. Every link in the chain depends on stability. Now imagine uncertainty replacing stability. Businesses begin asking difficult questions. Should we expand our factory this year? Should we delay hiring? Should we move production somewhere else? Should we diversify suppliers before new tariffs appear? When enough companies begin asking those questions simultaneously, investment slows. Hiring slows. Expansion slows. Economic growth becomes more cautious. Notice something important. None of this requires an actual trade war. Sometimes uncertainty itself produces measurable economic consequences. Financial markets understand this better than anyone. Whenever investors believe future profits may become less predictable, stock prices often react immediately. Not because today's earnings changed, but because tomorrow suddenly became harder to forecast. This is exactly why Wall Street pays so much attention to political developments involving international trade. Markets hate uncertainty. They always have. They always will. That uncertainty also affects consumers. If manufacturers pay more for imported materials, production costs increase. Transportation becomes more expensive. Warehousing costs rise. Insurance premiums increase. Eventually, businesses begin passing some of those expenses to customers. Higher prices appear slowly. Not overnight, but gradually. Consumers notice groceries becoming slightly more expensive. Home improvement materials cost more. Vehicles become less affordable. Appliances increase in price. Inflation often begins with small increases scattered across dozens of industries before becoming visible in official economic reports. For the Federal Reserve, these developments matter enormously. Persistent inflation complicates interest rate decisions. Higher interest rates affect mortgages, car loans, business borrowing, commercial real estate, corporate investment, stock market valuations. Suddenly, a policy disagreement between neighboring countries becomes a nationwide economic issue. This explains why professional investors watch North American trade negotiations almost as closely as central bank announcements. The long-term implications extend even further. One of Mark Carney's broader economic objectives has been encouraging Canada to diversify its international trade relationships. If Canadian businesses expand exports to Europe, Asia, or other global markets, American companies may eventually face increased competition in sectors where Canada once relied primarily on U.S. demand. That doesn't mean America automatically loses. The United States remains the world's largest economy. Its domestic consumer market remains unmatched. Its innovation ecosystem continues attracting global investment. But economic leadership is never guaranteed. Every major economy constantly adapts. Countries seek new partners. Companies seek lower costs. Investors seek better returns. Supply chains continue evolving. The biggest lesson from this story isn't whether 10 Republican states are actually in immediate danger. The real lesson is something much larger. Modern economic competition no longer depends only on who builds the strongest military. Increasingly, it depends on who controls supply chains, attracts investment, secures energy resources, and maintains resilient trade relationships. That may be why a simple map generated so much attention. Because behind that map lies one of the biggest economic questions facing North America today. How much does each country truly depend on the other? And if that relationship changes, who will adapt the fastest? But the story becomes even more interesting when we look beyond trade statistics and start examining individual industries. Because not every sector of the American economy would react the same way if trade tensions with Canada intensified. Some industries could experience only minor disruptions. Others could face billions of dollars in additional costs. Let's begin with manufacturing. For decades, North American manufacturing has been built around one simple principle: produce components wherever they can be made most efficiently. A single pickup truck assembled in the United States may cross the U.S. Canada border several times before reaching a dealership. The engine could be manufactured in one location, the transmission in another, steel from one supplier, electronics from another. Every border crossing saves money because the supply chain was designed for efficiency rather than politics. But when governments introduce uncertainty through tariffs or new trade restrictions, companies begin reconsidering those decisions. Instead of expanding production, executives may delay investments until they know where trade policy is heading. That uncertainty can slow factory construction, reduce hiring, and postpone billions of dollars in capital spending. Now consider energy. Many Americans don't realize how closely connected the U.S. and Canadian energy systems have become. Canada remains one of America's largest suppliers of crude oil. Natural gas pipelines connect both countries. Electricity flows across regional grids every day. If political tensions affect energy cooperation, wholesale energy prices could become more volatile. Higher fuel prices don't just affect drivers. They increase transportation costs for trucking companies. Airlines pay more for jet fuel. Factories pay more for electricity. Farmers pay more to operate machinery. Eventually, those higher expenses begin spreading throughout the economy. Agriculture presents another challenge. American farmers depend on stable export markets. Canada purchases billions of dollars worth of agricultural products every year. If Canadian buyers reduce imports from certain American producers, farmers may need to find new international customers. Finding those markets isn't impossible. But it rarely happens overnight. Agricultural businesses operate years in advance. Equipment purchases, land investments, crop planning, and financing decisions all depend upon predictable international demand. Trade uncertainty therefore creates financial risk long before harvest season arrives. Transportation companies face similar concerns. Railroads, truck fleets, shipping companies, warehouses, border logistics firms, all depend on enormous volumes of cross-border commerce. If trade slows, freight volumes may decline. If inspections increase, delivery times become longer. If regulations become more complicated, operating costs increase. Each additional expense eventually affects consumers. Then there is Wall Street. Financial markets dislike surprises. When uncertainty increases, institutional investors immediately begin asking difficult questions. Which companies generate significant revenue from Canadian customers? Which manufacturers depend heavily on Canadian suppliers? Which industries would benefit if production shifted back into the United States? These questions influence investment decisions involving billions of dollars. Sometimes markets react long before the broader economy does. Investors attempt to anticipate future events rather than simply responding after they occur. This explains why stock prices often move dramatically even before new trade policies officially take effect. Consumer confidence also becomes important. Economic growth depends heavily on household spending. When families become uncertain about inflation, employment, or future living costs, they often reduce discretionary purchases. Large purchases such as vehicles, home renovations, and vacations are frequently postponed. Businesses notice weaker demand. Hiring slows. Economic momentum begins cooling. This process doesn't require a recession. It only requires enough uncertainty to change consumer behavior. Perhaps the most important lesson is that neither the United States nor Canada truly benefits from prolonged economic confrontation. Both economies have spent decades becoming deeply integrated. Factories depend on suppliers across the border. Energy systems operate together. Transportation networks connect thousands of businesses. Millions of jobs rely directly or indirectly on this relationship. Breaking those connections would likely create costs for both countries. That is why many economists continue believing negotiation remains the most likely outcome. Political leaders may use tough language during negotiations. Markets may experience temporary volatility. Businesses may prepare contingency plans. But history suggests both countries ultimately recognize the enormous value of maintaining one of the world's largest trading partnerships. So when commentators say that Mark Carney pulled out a map, the map may symbolize something much larger than politics. It represents a reminder that economic geography still matters. Some regions remain more dependent on international trade than others. Some industries remain more vulnerable to policy changes than others. Understanding those differences may become increasingly important as North America enters a new period of economic competition. The biggest question now is not whether trade tensions will create headlines. The real question is whether policymakers on both sides can protect economic growth while defending their national interests. The answer to that question could shape jobs, investment, inflation, and financial markets across North America for years to come.